This week on Wealth Track, are index funds raging out of control? Are these passive, low-cost funds actually a threat to retirement savings? Wintergreen Fund's noted value investor David Winters sounds the alarm next on Consuelo Mac Wealth Track. I began the interview by asking Winters why he thinks the move to index funds is a dangerous market mania.
Well, the idea of index funds, Consuelo, is fine. But what's happened is it's become this universal truth. And people have poured more and more money into index funds. And because the way it works is they're capitalization weighted.
Why is market capitalization a problem?
Well, because the more that something goes up, the more you have to buy. And so the stocks that do the best, or that are most favored by the market, the index funds buy more and more of. And the companies that are not in favor, for example, the companies that are not what we call the bubble tech, biotech stocks, get sold. It's just the mechanics of it. It's a computer program.
So from a value investor perspective, as you are at Wintergreen, what are you seeing then? That the most expensive stocks are the ones that are getting the most owned in, let's say, an S&P 500 index fund?
Well, what's happened in the study that we've done, it shows that unless you own the most popular, most expensive securities, you can't outperform. And so what that does is it feeds into this idea that the index funds are promoting in their marketing that they are inherently superior. But what they're doing is they're getting the public, in our opinion, to buy ever more expensive securities and neglect what's undervalued. Investing is the only business, Consuelo, where people want to buy what's going up as opposed to get a good deal. Value investing is getting a good deal.
So another problem that's less obvious about indexation that you have highlighted, and we have a report that we will link to on our website, wealthtrack.com, is that the concentration of shareholder power in the big index firms, the Vanguards, the BlackRocks, and the State Street. I think you said that they hold 16% of the shares outstanding of the top 25 companies in the S&P 500. Why is that a problem?
Well, what it's done is it's ended up giving enormous power to a very few number of firms. And so they get to determine even, and the voting record is they basically have been voting 90%, give or take, in favor of every pay package. The great managers should get paid, but the most of them shouldn't get paid astronomical fees. And so what you end up losing is this dynamic of the shift of power that it's in too few people's hands, and they, in our opinion, they aren't using that power to rein in the excesses of what's going on in these big companies.
But hasn't that always been the case? I mean, haven't big institutional investors traditionally voted overwhelmingly for management anyhow, right? And I don't know what Wintergreen's record is of all of the, the stocks that you hold. I mean, you have a focused portfolio, but I don't know what percentage that, you have in voting for management either.
Well, we've tried to find companies that are not excessive in their behavior.
Right.
And so occasionally we've gotten, unfortunately, surprised, like by Coca-Cola last year, where they wanted to vote themselves this massive pay package when they weren't doing well. And so, we brought it to people's attention, and ultimately there were many shareholders who agreed, and the package was withdrawn.
And why is executive compensation and excessive executive compensation, and that depends on whose point of view you have, why is that a huge problem for you at Wintergreen? Why do you think it's something that we really need to pay attention to?
Well, there's two elements. It's not only the fee that people are paying for investment managers, and they could say that index funds are low fee, but we argue that they're actually very high cost because they've been rubber stampers for these massive pay packages. And if you give somewhere between 2 and 4% of the value of a company away every year as a gift to your buddies or your cronies, is the way it looks, what you're really doing is in 10 years or so, the ultimate shareholder has much less, and from a societal perspective, a group of few people have a lot of money, and the American public basically gets left holding the bag.
Let me go back to the concept of the popularity of index funds being a market mania. And you say it's akin to something like the Nifty 50, to the tech bubble. You know, why do you view it that way? Why do you think it's so dangerous?
Well, what's happened, Consuelo, is that the money and the money flows have increasingly gone into the index.
Right.
And people have been told that the index is it. And, you know, again, it's a self-fulfilling prophecy. And it's a very narrow group of securities that are going up. And increasingly, we can tell from the numbers that are reported from the New York Stock Exchange that people are borrowing money. And considering you can tell what people are doing with the money,
right,
they're either borrowing on their mutual funds or on ETFs. And so you've got this small group of companies that are very, very richly valued. And, you know, if history is a guide, sooner or later they pop.